Okay, guys, we have to be honest with ourselves. There's a lot of bears that are starting to come out because, after all, today was the first red day since the election, and it's kind of twisting people the wrong way, if you know what I mean. Now, here in this video, we will discuss the bear case, the bull case, what's going on with markets, what happened today, tomorrow's data with CPI and how important that'll be. You also had the Fed that basically said today that if CPI comes in hot tomorrow, you may not get a cut in December. Obviously, who knows if that's a little forward guidance or not. But the markets today sold off a bit for the Russell and the Dow. But you know what happened? Investors were cool as a cucumber. They didn't care at all. The VIX fell 2%, almost 2%. That's a sign of something, and we will discuss that in this video. It's Roberts on X writes, okay, the bullishness is getting out of hand, but I am happy to ride it. Yardini's new take on the current backdrop says, quote, we are raising our S&P 500 year-end target as follows: 6,100 for 2024, 7,000 for 2025, and 8,000 by 2026. We are now targeting 10,000 by the end of the decade. That's a 66.6% increase from 6,000 over the next 5 years. We believe these forecasts are consistent with our Roaring 2020 scenario, which is receiving a boost from the animal spirits that should result from Trump's 2.0 economic policies. We also expect that the animal spirits will intensify as the wars between Russia and Ukraine and in the Middle East are resolved sooner rather than later. Which honestly is a good point, because if those wars do come to an end, that is something that could have a positive impact on markets. I also think another positive impact on markets will be in the form of Trump's tariffs just not being as bad as people fear. Instead of being on things like food or things like household supplies or, things like materials necessarily, it may be on select, semiconductors, which is already a thing, right? It might be on car parts, which won't really impact the economy. It might be on things like oil, which, that could definitely cause oil to rise. But how much of a logistical impact would that actually be, since we do draw a lot of our own oil? Instead of maybe shipping that to another country, it would just stay in the US. Like, there can be ways to create these tariffs that don't necessarily raise costs or boost inflation and have all of these very negative impacts. Maybe we won't get much for tariffs at all. Okay, I think that is a positive upside surprise at this point for the markets, based on current expectations that we will see a lot of tariffs. Now, Sven Hendrick on X post this. What this is basically doing is it's taking 4 different ways of evaluating our markets. Crestmont PE from its geometric mean, cyclical PE 10 from its geometric mean, Q ratio from its geometric mean, and S&P composite from its regression, and you can see you're at 159%, pretty much where you were at the peak of 2021. And again, this is another argument that maybe you're getting close to a peak in markets. It's also being reported that net long positions among asset managers in Russell 2000 futures are at the highest level since early 2021. Now, what actually happened during this time in early 2021, the Russell actually went up from about the start of, let's call it 2021, about January or so, this low here. We actually went up about 29% between then and the all-time high on the Russell that we hit back here, November 8th, 2021. So, you did rally a lot more from that point, from the point in which you got to those, overextended levels, some people will call it. Golden writes on X, the first cemented SPX 2025 price target with a 7 handle from Capital Economics' John Higgins, whom was also the first with a 6,000 price target, formally June of 2024. Investors thought he was crazy with 6,000 objective then. What are they saying about his 7,000 price objective for 2025? There's more positive feedback Long story short, with this 7,000 price target for 2025. Kurt S. Alkwriter on X, he's a wealth manager or wealth advisor for high-income entrepreneurs. He says, we're likely in the final phase of the bull market cycle, the blow-off phase, with sub-phases of renewed optimism, FOMO, and now possibly euphoria. Last week's 5% gain in the S&P 500, despite late cycle signals like a yield curve inversion and rising unemployment, suggest we're near the peak. The presidential election may support business sentiment, but it doesn't shift the economic trend overnight. This looks more like a late cycle rally with growing risks than the start of a new bull market. And let me just tell you this. This guy's probably really smart, and I agree. He's not wrong. Like, this looks like a blow off top rally. This looks like FOMO. This looks like we're even possibly at euphoria stage. Now, there's some things that I could push back against that, but generally speaking, I think that's correct. The problem that smart people have, and why smart people actually tend to underperform over the long term, is because investing and returns have no correlation to knowledge or brains. Okay, they have correlation to, one, staying in markets, compounding your money, but two, markets don't care if you're right or wrong. Markets do not act rationally. And if we were thinking about the markets in a more rational sense, based on valuations and based on where, maybe the business cycle is, you would say, yeah, you're probably at the point of a peak. Now, depending on what your time frame is, a peak's going to look different. Some people are going to say we already hit the peak. Some people are going to say a peak could take 2 weeks, a month. Some people are going to say, who knows? We could see a peak in the next 6 months. I think there's going to be various different opinions on that. But to try to pinpoint a moment that, we've hit the top and we're going to fall into some kind of bear market is a very hard game to play. And even the smartest individuals, they tend to get things wrong the most. Like, you think Mike Wilson or some of the other, infamous bears we've seen over the last couple of years are dumb people? No. I don't think you get to be in very important jobs being a stupid person, that's for sure. But they were wrong in their bear theses over the last couple of years. And a lot of people were wrong being a bear over the last couple of years. And the smarter you are, the more you tend to be wrong, because markets, they don't act very rationally. And I think while this is a rational take, I don't think it's as simple as how this individual puts it. And trust me, we will talk about my expectations in just a moment. But first, here is a look at where key US index ETFs stand relative to their normal trading ranges. First, standard deviation above and below the 50-day moving average. As you can see, basically everything is extremely overbought. The Russell 2000, Russell Midcap, S&P Midcap 400, Total Stock Market ETF, Russell 1000 ETF, S&P 500 ETF. Everything is extremely overbought relative to standard deviations and where their 50-day moving averages are, okay? Only the NASDAQ 100 is just overbought, and the S&P 100 ETF is just overbought. Everything else is extremely overbought. Carl on X cites the Goldman Sachs desk today that says, quote, while the bar to be outright bearish feels relatively high right now, in the spirit of being balanced, two potential yellow lights to be mindful of. Number one, equities tend to struggle to digest very sharp moves in interest rates, similar to the one we've seen. And two, GIR's sentiment indicator is now firmly in stretched territory. So you are stretched in markets is the simplest way to put it. And U.S. equity positioning surges to an 11-year high post-Trump win, according to Bank of America's analyst James Wong. The percentage of fund managers who report being overweight in U.S. stocks almost tripled reaching a net 29%. Now, Seth Golden writes on X, what does the S&P 500 PE and Taylor Swift have in common? They both feel like 22. Unfortunately for both Swift and SPX PE, feeling like 22 hasn't proven sustainable. In 1999, a 22 times forward PE was a topping signal. In 2021, a 22 times forward PE was a topping signal. In 2024, a 22 times PE, could 24 times PE be achieved before the top? And he's basically pointing out that you are at about a peak in valuations for our markets historically, with the average S&P P multiple over the past 25 years being at about 16.4 times. What's actually fascinating here is if you look right here, the PE ratio versus the S&P 500. The Mag 7's combined PE ratio is a little under 30, which is higher than the S&P 500's PE ratio of almost 22. However, the S&P 500's PE ratio, excluding the Mag 7, is closer to its historical average of around 18. This is actually one of the arguments that Tom Lee has made in recent days. That yes, if you look at the S&P, things look expensive. They look overvalued. We look stretched on positioning. But if you actually exclude those Mag 7 names, the markets don't look nearly as overextended or overvalued as they actually are, right? And you could say that doesn't matter, or this or that, but I would argue that Mag 7 now has about 40% weighting in the S&P. That was not the situation in any other cycle in history. So the markets are really just top heavy here. And to a certain extent, you could see Mag 7 sell off and the rest of the markets rally and still get the S&P that would fall a bit, or maybe go up at a very modest pace, not just straight up in a line like we have seen recently. So to a certain extent, the valuation argument just doesn't matter much to me unless you decompose what we're actually talking about. Yeah, if we're talking about the headline S&P, then I don't think a 22 times multiple means much. Do I think Mag 7 at a 30 times multiple is giving you much room for error? No. Do I think the markets are super overvalued if we're looking at the average stock that's trading at about an 18 times multiple, which is historically average? I don't think that's a stretch at all. I don't think from that perspective markets are too stretched or too overvalued. Now, here's the deal. I've said it before here on this channel, and I'll say it again. Valuations don't matter in the near term. Nobody wakes up one day and says, I'm going to sell this stock or that stock or the index solely based on valuation alone. People decide to sell stocks for a lot of different reasons, but it's very rarely because of valuation. Most of the time it has to do with maybe sentiment that falls, or it has to do with momentum that starts to slow down, right? That tends to be a bigger trigger for people to sell stocks than actual valuations. Okay, now here's the deal. Valuations, they're not bad from the standpoint of if everything goes fine. I think the correction comes that everyone's starting to predict when the economy gets worse, because we're basically pricing in a perfect scenario for the economy, and we're probably not going to get that. Even if we don't go to the extreme of things, even if it's not, super hot boom time economy, everything's just fine, or, depression, right? Even if we're not on the far end of those spectrums, those deviations, if you will, you're not going to be right in the middle of everything is fine everywhere, okay? It's not red hot, it's not recessionary, it's just fine. I think you're going to have a bit of a back and forth kind of economic cycle or data cycle that will start to play out towards the end of this year. And that's what will give us the correction when the economic data starts to come in bad. Now, that's just my opinion. take that as you will. Wall Street could perhaps price in some of that ahead of time, but at this point, it doesn't look like Wall Street cares much about that. This is the first, really, I guess, red day we've seen since November 5th. So yeah, of course the bears are coming out today. They're coming out in full force to tell you this is the top of the market and you need to sell stocks and you need to be scared and concerned. But in all actuality, this is actually healthy, right? To get a little bit of a consolidation, to get things that relax. And even from my perspective, I mean, look at the RSI. The RSI is at 66.95. I mean, back here in July, yes, it was the peak of the markets before a correction. The RSI was at 82.5. Like, there's still more room for upside in the S&P. I find it a little bit harder to fathom, large upside for big tech at this point. It just doesn't make sense. Like, why would you own big tech right now with the valuations the way they are, with the growth rates the way they are, just not as nearly as attractive as the rest of the markets, right? So I think there's an issue structurally with how much Mag 7 is run relative to the rest of the markets. And that's why I've been calling for a broadening out of our markets. And that is what has been happening in recent days. And I think that is what is going to continue. You could see, the equal weight, the average stock in the S&P, get a 20 times PE multiple. And that still wouldn't be too bad. Let's say you did get up to, 22 or so, 24. That would start to be on the stretch side. Maybe you'd be a little bit concerned at that point. But as far as the average stock and what's happening in the markets, this is not like 2021 levels of euphoria where BS companies went up just every day for no reason. You're not at that point. You're just not. Simply as that. If you look at the headline S&P, perhaps you could say we're there. So I think it's a tricky environment that we're in. I definitely wouldn't want to be long Mag 7. The equal weight is where I would want to be. Small and mid caps specifically is where I would want to be. I would stay away from the larger cap names that have slower growth rates, especially. That's what tends to happen when you become a large company anyways. So that's where I see the opportunity right now. And theoretically, you could see big tech, Mag 7 sell off, and the rest of the markets rally higher, kind of like what we've seen in recent days. And it doesn't do much to valuations. Valuations really haven't moved in the last couple of days. Yes, the S&P has went up a little bit, but relative to the rest of the markets, it hasn't been that dramatic. Not nearly as dramatic as you would think. I mean, the S&P since Trump won is only up about 4.89%. I believe if you actually take from the open of November 5th, you're only up like 3%, 3.3% or so. Like, there hasn't been much of a rally in the S&P. It's mostly been in your average stocks, in your biopharmas, your small caps, right? Cryptos, which just don't affect the S&P as much. So very tricky environment that we are in. Now, as far as tomorrow, we're going to have our CPI report. I talked about this a little bit in the last video, but just so we're all on the same page, if CPI comes in on the hot side, we have a bit of a problem. Now, it was reported from the Fed today that if CPI comes in hot before the December meeting, that you could see a bit of a pause. And I don't know if I actually shared it. Let me go find it real quick. Okay, so at about 2 p.m. today, Fed Kashkari says if inflation surprises to the upside before December, that might give us pause. And what really happened today is exactly that. Fears kind of grew that you could see a surprise on inflation, that you could see inflation come in hot tomorrow. What's actually interesting about this is you've seen a sell-off in the Russell, down almost 2%. The Dow was down almost 1%. S&P down 1/3 of 1%. The NASDAQ down 1/10 of 1%. So the NASDAQ didn't do nearly as bad. Kind of that let's pile into Mag 7 trade happened today, pretty typical of what you've seen over the past couple of years. Why valuations are so stretched in Mag 7, by the way. But the reason I'm really not concerned about tomorrow is the VIX. The VIX was down almost 2% today. Any day the Russell is down almost 2% and the VIX is down as well tells me that there's not a lot to be concerned about. Now, I was a little bit more concerned before the election, the couple of weeks before the election, because the VIX was in the 20s and markets were just staying at their highs. That was a little bit more concerning because that said, there was hedges being put on our markets, a lot of them. There was a lot of fear under the surface and price was not reacting to it. Now, ultimately, we got to buy the news event, a face ripper-like rally in a lot of areas once Trump became the president-elect for, the 47th president. I think a lot of the kind of sell-off we've seen in the VIX following the election was because there was not a contested election. I think that was really the thing that Wall Street was concerned about. But nonetheless, today, there wasn't any fear out there. Now, bonds were up about 12 basis points today to 4.42%, almost hitting a new cycle high. The previous cycle high was, actually today you did briefly hit a new high since the election of about 4.44 basis points. You did come back down to the high that you've seen on November 6th. So I think you're in one of those positions where if CPI comes in line with expectations, not a big deal. Markets probably move higher on that. 10-year Treasury yields probably move lower. If inflation comes in hot tomorrow, like undeniably hot, then you have a bigger problem. But I don't think it's going to be a problem that gives us any, severe downside. Could a 5% downside move happen? Of course, that can happen for little reasoning. Does it give you a 10, 20% downside move just because inflation comes in hot? Probably not. I think that correction comes via the economic data. And we do get retail sales coming out on Friday as well. But long story short, I think you priced in the bad news today, and there's a greater chance now that you actually see an upside move coming over, the next 2 days or so, as long as CPI does not come in too hot. And again, after all, there wasn't really a lot of hedges being bought today. Not at all. The VIX went down, and it was only at 15 to begin with. So there's not a lot of fear out there, but equities reacted. So let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.